Hey, good morning, everyone. Marty Mazzora here. It is the 3rd of November, 2021 with your technical market update. Going to run through the charts with you. We're going to start with the shortest time frame we've been working on lately, which is the 60-minute, 60-day S&P 500 chart. We'll work our way all the way out to the monthly. Then I want to talk about breadth, which is a topic we've been exploring a bit lately on the blog, and want to, as promised, take a look and do a little work on the Japan equity market chart and show you why technically I'm really liking what I'm seeing right here. Okay, so again, the 60-minute chart of the S&P 500 should look familiar to you. Remember, we were really bullish right in here based on this falling wedge, bullish divergences, little consolidation in here, still bullish. Gave you a bearish tune here. I had this highlighted in red all the way down. We had another rising wedge, falling divergences. Sure enough, we did break below there. We got that last week of October. We got some selling in here. And right now, if I update this, just with these lines here, we still have that look and we still have these extended divergences here. This is just for those of you who are looking at this stuff day to day and are telling me you really find these, even these short-term analyses quite interesting. So that's what that's for. Are they instructive? Is an hourly chart instructive in terms of what we do here at PWA on behalf of our clients? Well, no, of course not. But do we look at markets and the positions we're in across all time frames? Yeah, we actually do. Okay, so the 2-hour 60-day chart, again, equally bullish right here. This was actually a bullish looking consolidation, more so than on the hourly chart. We had our bearish look here, broke down below that a bit, but catching steam again. Still that same bearish pattern, still the same divergences, pretty much pretty much a reflection of what we just saw in the hourly chart. So short term, this market looks a little heavy. Looks like we could get a breakdown. No sell signals right here. Of course, the Fed's meeting today, that could move the needle in either direction. I mentioned that on the morning note. That's actually one I'd like you all to read if you haven't had a chance yet. If the Fed surprises in a hawkish tone, I think the market's going to hate that. But I think that in this environment, with seasonality and with sentiments getting a little complacent, so that could lead to some more downside. But probably should be bullish to the end of the year for equities. Maybe a different story when the calendar turns over. Of course, we'll do a lot of work with you here on the blog between now and then to show you what we think is likely or what probabilities suggest. But anyway, for now, the short-term charts are suspect, but again, among other things, seasonality, it's pretty bullish right here. So I'll zoom in, first of all, just on the daily price chart here, and just show you, this is just a long rising wedge pattern. Okay, this in and of itself is clearly a bearish pattern. The fact that we tested that 50-day moving average with a bigger test than we've seen of late and then survived it, and now the 50-day moving average is sloping back up, that's bullish. No ifs, ands, or buts about it technically. But you still basically have that same pattern, that same rising wedge pattern. You can see, you can see how that looks in here, right? Those are just, those are just patterns that typically, ultimately, work out to where you get some downside pressure. You wouldn't trade this until you get a break out of the range and a break of the 50-day moving average. So really nice trade here for anybody who went short on that break, but they had to have their stops pretty tight, and if they did some swing trading, they did very well catching this right in here, or if they just got out, they had a nice move. The bulls coming in here when we broke back above that 50-day moving average, again, speaking like a trader, that's been a good move, and we are right now breaking out to new all-time highs. Now, this would be what another technician might say is this is crazy bullish. You have a good breakout, you've got it with some momentum, at least on the price chart, not on the volume though. The volume looks pretty weak, frankly. But you have a breakout, you have a little test of that breakout, and this looks good. And if you did some sort of measured move, you might be up here another 100 or 150 points in the S&P by the end of the year. That is very much within the realm of possibility, folks. What I'm looking at is these longer term trends that are, met by negative divergences in the MACD and the RSI. These are the kinds of trends that develop ahead of, market cracks. And I think I said this last time, and I'll say this over and over again. Just because these patterns are forming, and I think they're very clear patterns, I don't have to stretch to make this pattern, and you've got these divergences, in no way, shape, or form means that they're going to work out that way. We could blow through these and we could just keep, rising on into the horizon. However, I will say that when the market ultimately does crack, it's likely to be preceded by patterns and divergences that look like this. That's how it tends to work out. But they don't all work out that way. So what does it do for us as investors? Well, when you see this on the longer term charts, and let me go to the weekly, you begin to get, even more concerned. So on the weekly chart, again, you have that rising pattern. You've got these clear divergences. These are times when you really just want to make sure that you've got, your ducks in a row, that you're hedged properly, that you're properly diversified, right? You can see the divergences. You can see what happened here. You can see, here you can see you have a higher high, you have a lower high, you have a lower high, right? And what do you have there? And that was 2018. That was a 19.8%, start to finish decline in the market. So again, but at the same time, let me say it one more time. Even on the weekly, what do we have? We have a breakout, threatening a breakout on the weekly, and that's bullish. And let me say it for probably the fourth time this morning. Seasonality looks pretty compelling right now. And then lastly for this one, let's go to a 10-year monthly chart. This looks constructive. Save of course for this rising wedge pattern, right? But you have a MACD that looks very solidly in a buy signal. You do have a negative divergence on the RSI, but you don't have that on the MACD. I suspect that may change over the course of the next few, 3 to 12 months, but, we'll see on top of it and we'll see how these things develop. Clearly you would say that there is some loss of momentum here, even on the longer term chart. But again, I can't say that this is bearish, and so I won't at this point. Okay, let's jump into breadth via the advanced decline line. So I think it was a week or so ago, we were looking at the S&P 500, breaking into new all-time high territory. That's the price chart here. But the advanced decline line on a shorter term one, this was looking like it was going to roll, like it was rolling over. So I said, ooh, even on the S&P, the breadth is beginning to look suspect. Well, scratch that, because now we have the breadth now peaking above and looking at a new all-time high as well. So the breadth in the S&P appears to be, at least at first glance, trying to confirm positively this breakout in the S&P. Now, I featured the NASDAQ recently, and I said that's important to feature because, as I quoted in this morning's blog post, this is a very, very concentrated market. And the NASDAQ really reflects the growthy tech names, if you will, the long duration stocks, if you will. And so this is a breadth chart that should have us thinking twice about what's going on. It's the advanced decline line for the NASDAQ. So essentially how that works is this line moves up as advancers lead decliners, and it moves down as decliners lead advancers. And here we have a NASDAQ composite peeking its head into new all-time high territory. And we have a very dramatically different advanced decline line, like we did here before this 13% decline. This one, you really didn't get that signal from the AD line. You did here in front of this 9% decline. You absolutely did here. Even before the COVID lockdown happened, you had a real negative divergence in the AD line versus the NASDAQ itself before everything fell apart. And you got it here before this 23% decline and so on. And I could do this all day and go back, decades. But yeah, again, not a reason to sell, not a reason to necessarily lose any sleep, but a reason to do what we're doing within client portfolios, and that is hedging, with options, and diversifying and owning some things that kind of correlate differently to what everybody seems to be buying. What I keep hearing myself say in client reviews is it seems like everybody's trading the old bull market. And if they think conditions are the same as they've been since the bottom in 2009, oof, ultimately I think they have another thing coming. But as long as, there's enough force behind that trade, it keeps going. So I'm not here to say that I know when or even if, things change. But I can tell you this, under the surface things have changed dramatically in terms of the structure and the setup. And we are tilting, our core portfolio in the direction of where we think the flow is going to be going forward. One that I mentioned the other day on the blog was the Japanese index. And I just hinted that this is a really bullish chart, right? So this is about 30 years ago where we met resistance right here, the Japanese equity index did. And then here again, a couple decades later, and then here again recently, and you can see this breakout. So let's work on that chart just real quick and I'll let you go. And so here's that long-term chart, and I'll show you what all this noise is over here in a second. So, you did have this range in here where we just kept boom, 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 my dotted line of resistance, right? Broke through it. People may have got excited right here and then lost it. Really looks like a head and shoulders pattern right there. This would be your neckline, kind of right in there. You can see it kind of hit that, bounced around, and then when it lost it, boy, it really lost it. And so here we were in late 2017, 2018, bouncing off that again. Here, as you can see, we broke out of there with some pretty strong, upward movement there. Came back, tested it again, and then bounced off of that pretty impressively again. Let me just zero in on this, and I'll show you what I'm seeing. So these are flag patterns, right? So a technician would tell you that this is a bull flag. So you have the bottom here. You have the rally out, and you have this consolidation phase. And typically in a good flag pattern, you retrace about 38% of the move. That's that first real serious Fibonacci line. And so here's the move. Here's the retracement, just above the 38% retracement. And then we bounced out, and then we broke out of the flag pattern here. And then we came back and we tested that breakout spot just on the nose. You could come down and test this trend ultimately as well. But it stopped right there, and then it shot up. Now, if you have a flag pattern and you get this breakout, you're going to have an upside target the length of the previous flagpole, right? So let me just, I'll copy that, and then I'll move it up here. And as you can see, pretty close, right there, actually exceeded it if you want to go to this range right here, but it wasn't, it wasn't a bad tool. So anybody who's viewed that as a flag pattern and played it had a pretty good run, and they probably would have begun right here at this first peak to take their profits or move their stops right up to that level or what have you. And then sure enough, here's your consolidation. We broke out right here, and then but came down and really lost it in there. And, if you want to make that your downtrend, though, you could say that it just kind of tested that and then caught its steam again. If we zoom back out a few years and we draw that next flagpole, we get really close to that January 1990 high. And that's a big move from here, folks. This is unambiguously a bullish look for Japan. Now, Japan is big in our portfolio. In fact, in terms of foreign countries, because of our big position in Asia Pacific right now, which we think offers value relative to U.S. equities, Japan ends up being, our biggest non-U.S. weighting. So we like that right here. I think you're going to see a bit more fiscal activity in the Japanese economy, and that's probably pretty bullish right here, particularly when you look at this breakout for the Japanese market. So I've kept you long enough for one session, folks. I'll leave it there. Thank you, as always, for watching and listening. Stay tuned. We'll be back. Take care. Bye-bye.